Hello, listeners. My name is Kerry Satchery, and I'm the head of distribution at Catalyst Fund Managers. And I'm so excited to have you back in studio with me, Theo, on the Real Assets Roundup. But this time, as opposed to talking about property, we're going to be looking at infrastructure. You are the co-portfolio manager on the recently launched Global Listed Infrastructure Fund alongside Mvula Soroto. And the fund has just reached its 12-month or just passed its 12-month track record in December. But to be fair, I feel like at Catalyst, we've been managing property for a lot longer periods, and there's a lot of similarities between property and infrastructure. So perhaps you can touch on those similarities and how that experience translates, and then just take it a step back actually and just explain to us, what is global listed infrastructure in the first instance.
Thanks for having me, Gary. Yes, you're right. There's a lot of similarities between infrastructure and real estate. Firstly, maybe what are we speaking about when we talk about infrastructure? There are some subsectors. Generally, it has a lot to do with the production and transport of energy. Companies that own transmission lines or pipelines that transport energy from where it's extracted to where it is ultimately processed or used. Then we also have the transport sectors, being railroads or airports or toll roads. And then where there's a big overlap between the real estate universe, you've got cell phone towers and data centers. So both of these sectors are physical assets that produce long-dated income streams. I would say the infrastructure universe generally has higher barriers to entry because it's often regulated business models. But the risk and return profiles are often very similar. And that's why we think that our process and our philosophy and methodology of valuing and investing in real estate transfers well into the infrastructure space.
Makes a lot of sense, and you can see those similarities between property and infrastructure. How does it compare to listed equities, for example, if you're looking at risk and return metrics?
I think on the fundamental operating level, the infrastructure companies are essential services, and you have higher visibility or I would say stability in earning streams. You don't really have years where earnings go back a lot. You generally have longer periods of visibility and forecastability in the income streams. And most of the business models have got inbuilt inflation indexation adjustments in there. So regulators would adjust the prices that electricity suppliers can charge with inflation. So you generally don't have like inflation scares, and that's where the real asset comes from, to give you a real return.
You sound like you know what you're talking about, which is good, seeing as you're the specialist on the portfolios. For those investors that are new to this asset class, right, listed infrastructure isn't necessarily the main conversation at conferences, and it's coming up more and more in conversations today. Is there any particular elements of listed infrastructure that maybe the market don't understand or that they underestimate when it comes to this asset class?
Yes, I think generally speaking, I would say when we speak to new investors or people interested in the space, they are generally surprised by the trajectory of growth in the sector. So it's a sector that gives you a yield, call it 3 to 4% dividend yield on day one, but 5 to 6 to 7% growth per year. And a lot of that growth comes from where we are globally now. There's a lot of capital that goes into upgrading infrastructure. So whether those are toll roads or electricity transmission networks, as countries shift the mix of energy from just, let's say, traditional hydrocarbons, coal, introducing more renewable energy, this necessitates big upgrades in the grids because it's a lot more complex to regulate energy flows. And this increase in capital drives the growth in the earnings stream. Because these are regulated profit business models, additional capex in the sector translates into additional growth. So I would say the last few years we've reached like an inflection point where growth is accelerated, and it is from an increase in demand in the underlying product, a lot of it electricity, or urbanization. There are more people on the toll roads, there are more goods being transported. So maybe infrastructure is traditionally seen as a bit more sleepy, kind of boring sector, but we're seeing really strong, robust drivers in the underlying earning streams.
Thanks for that, and it sounds like there's a really compelling case for why now. If you look back at performance, what do the returns actually look like over the last 10, 15 years?
So If you compare, let's say, the last 25 years since we've started managing money, the infrastructure sector has delivered roughly the same annualized return as the kind of global equities. If you look at the MSCI World Index, I think over the last 25 years, it's given you just over 8% a year return in dollars. And the infrastructure sector has matched that, but at a slightly lower volatility because the underlying earning streams are a lot more robust and stable. You've had lower drawdowns in market sell-offs. And so the combination of robust earning streams and lower volatility really adds to a compelling case for risk-adjusted returns.
It's really interesting you say that, because when people are constructing multi-asset portfolios, a huge reason for it is diversification, yes, but it's also managing volatility and those real risk-adjusted returns. So for investors that are thinking about allocating a portion of portfolios to infrastructure, what role do you see that playing in a multi-asset portfolio? Is there specific exposure that you think would be appropriate for a multi-asset portfolio?
Yeah, I think if you look at the fact that the sector does give you a day one yield, there's a dividend yield, let's say between 3 and 4%. So there's income from it, but then there's also the growth component and the real growth in that. So inflation wouldn't eat into that growth. So it's giving you, I would say, somewhere between 9 and 10% total return outlook with the ability to keep up with inflation. So if there's inflation surprises, you won't lose out like you would with bonds. As we know, inflation is a really big headwind for bonds, which are nominal assets. And then on the growth side, there are a lot of robust drivers that drive the growth, and the earnings, I think is a lot more secure and forecastable. Who knows what the next, big tech companies will do and how their earnings will evolve. But if you look back at, let's say, 25 years ago, the top 10 companies in the S&P, almost none of them are on the top 10 today. It's very dynamic and changes quickly. Whereas if you look at the infrastructure space, because it's regulated and there's a lot of high barriers to entry, you can't really compete. You can't build a new toll road next to a current toll road. You can't build a new electricity transmission competition in a state where there's already an electricity transmitter. So I think the forecastability, the lower volatility from the robust earning stream really adds to the risk-adjusted returns in any portfolio. As you increase the infrastructure component in a portfolio that has equities and bonds and some other assets in there, it increases your Sharpe ratios and your return metrics.
So it sounds like another great tool to add to the toolkit for those investors. I'm very excited to see where infrastructure goes in this space, and it's been brilliant having you on the Real Assets Roundup, Take 2, Episode 2. I look forward to chatting more in the future.
Thanks, Gary. Thanks for having us. And, I would encourage anyone interested in the space to reach out and find more information.
Definitely. Thank you.